I like the risk reversal here, but first of all, why don't we talk about the 155s and just how much premium we're getting for selling those puts?
Well, yeah. So what drew this trade to my attention was the fact that the 155 puts, which are significantly out of the money from where we are right now,
20
we were able
points.
to. What's that?
20 points.
Yeah, 20 points. We were able to sell those today for $4.25, which, that's neither good nor bad. I mean, I think it's good, actually, but
I thought it
the
was
fact,
great.
yeah, but the fact that we have a very clear level of support that we're leaning against here, right around 170. We've got a lot of places where we are clearly wrong, JC. If it breaks 170, I think we're pretty wrong. If it breaks 165, I think we're definitely wrong. Yet we're selling the 155 puts, so there's a lot of room to be wrong in those. And so when I looked at selling those 155 puts and I saw that I could get 425 for them, and then I looked at the other side of the ledger and saw that I could buy the 190 calls for less than 425, I said, boy, I like my odds here. I like the chances here, because if Russell holds this level like we think it will, like the odds favor that it will,
It
and
might.
if we start bouncing and we approach, last summer's highs, man, this trade's going to pay very well.
So there's two things that I like about this. Number one, the juice selling those puts 20 points out of the money was way more than I thought we were getting. Right. So that's number one. One of the points that you made is that a lot of regional banks in there juiced up those premiums. So that makes sense. But with that, then we can just take that money and buy the out of the money calls on the 190s, come in with a slight net credit. We're getting paid to put this trade on. Like what?
Right.
This really caught me off guard. I got to tell you, Sean, I didn't realize, and we're going to October. That's only 5 months, and we're getting that much that far away. I mean, I think you got to take it, especially because 170 is the level. We're 4 or 5 points away from 170. If we got to close in the IWM below that, we unravel the entire trade, and I don't think we're going to get hurt too bad in that scenario at all, because to your point, the strike is so far away. So in this particular market environment, what do you do? I really like this one. I really do.
Yeah, I like this trade for a lot of reasons. But the nice thing is that if this thing starts going our way, it doesn't have to go our way very far for us to be able to take some defensive action that actually is offensive action, if you think about it, JC. Because what we're going to do is, if this position goes our way, I'm going to keep an eye on the value of the options, right? I'm going to look at the value of the calls versus the value of the puts. If at any point in time those puts have declined in value such that they're half of the value of my calls, let's just make up numbers here. Let's say the calls are trading at $3 a contract and the puts are trading at $1.50, then I'm going to sell half of my calls and cover all of my short puts. So it's defensive in the fact that I'm taking my puts off, and now I can't get hurt on any kind of massive sell off. But it's offensive because now I have uncapped upside with no risk to my original risk capital in the trade. It's a free ride, as we like to say right here. We say it all the time. And it's the best kind of free ride because we will actually have credits in the trade built in. So we already have a built-in profit if we find ourselves in that situation where we've covered the puts and we're still riding half the calls.
Listen,
Good place to
there's
be.
so many things that make this trade attractive, particularly in this environment, where it's like, okay, well, how do we act? The S&P's range bound, the small caps look like they're about to fall apart, blah, blah, blah. And it's like, well, what if they don't fall apart? Right? If they do, fine. We unravel the trade. If IWM breaks below 170, no big deal. We move on to the next one, right? On to the next one. Fine.
Yeah,
Right?
and you know what? The other thing too is, let's say that this stock or the IWM, the index, just kind of meanders. It doesn't really do anything. It doesn't break our stop loss level, but it doesn't really go up either. It just kind of continues muddling around in this little range that we've been in for the past several months. You know what? That's not a terrible outcome, because what will happen for us is the calls that were long and the puts that were short, they will both expire away worthless, and we'll walk away keeping the. I collected 30 cents when I put the trade on today, so I'm not in it for 30 cents. I'm not trying to win 30 cents, but hey, if nothing happens here, at least I know I'm walking away with 30 cents, and that's better than a sharp stick in the eye.
Yeah, it ends up being close to a wash at the end of the day, whether we were getting a small net credit or it was a small net debit. That's the whole point, right? To sell the puts, take that cha-cha and pay for those out of the money calls, right? So just to be clear, what are we doing? We are entering into an IWM. This is the Russell 2000 ETF, IWM October bullish 155, 190 risk reversal. Again, for a small net credit. That means that we're naked short the 155 puts and long an equal amount of the 190 calls. This is in October, of course. I really like this one. I'm still a little bit surprised at just how much juice we're getting. I mean, I can't get over it. I was like a little kid in a candy store. I'm like, come again? We're getting how much? I feel like, you know, you take it when you can get it, and they're giving it away. So I say take it.
A small little note here too, for people who might trade with smaller accounts, or just don't have the available buying power, or just are uncomfortable with naked risk. One small tweak you could do to this trade is you can take some of that credit that we receive for this trade, the net credit, and buy some out of the money puts, just as a little downside protection, a little peace of mind, or just to make your retail broker happy that ties up less margin. So when you define your risk, it'll require less margin. So,
And then what do you buy? You buy the 145s or the 150s?
you would probably want to go further away. I don't think I'd want to spend more than 50 cents for a put if I'm going to have to do it. And that'll probably be, I don't have the prices in front of me, but probably $30 away. But it's really just as a method of reducing the margin requirement. That would probably cut the margin requirement down by 60 or 70%.
Well, I, for one, am not going to do that. I'm going to go ahead and take that credit. And I think that I can be disciplined enough. If we break 170 to unravel that trade, I have no problem with that. I don't need to make my broker happy. I'm usually pissing him off, but that's another story. Again, the IWM October bullish 155, 190 risk reversal. Small net credit means that we are naked short the 155 puts in IWM, the October 155 puts, long an equal amount of the 190 calls. Ladies and gentlemen, Sean McLaughlin. Make sure to follow him at Options Sean on Twitter. Make sure to follow me at All Star Charts, and YOLO responsibly.
Take care, everybody.
Adios. Kind of a